Welcome to the first lecture about my DTR blueprint model, and this is my most profitable model that I do have and I've made the most money with. Every time you sit in front of the charts and you're confused about where the market wants to go and you're framing a bias which can go higher and lower, this model is going to give you the complete framework you need to know where the market wants to go. So it's not just a model, it's a framework that you need to start making money from the markets. With all that being said, before I dive into teaching this model, if you want the full PDF guide of how I trade this model, and it's a checklist going over the A plus setups, the B plus setups for the different sessions, which we are going to go over for this model, go into the link in the description and it will be the first link. Let's go over the overview first of what I'm going to be teaching you. So first of all, I'm going to be teaching you the model's foundation. So what builds up this model and how you can identify it first before it even forms. And then I'm going to teach you about the key PD arrays that you will be using and how to correctly align your timeframes, because this is the most important part. And then finally, I'm going to show you how the A plus setups form and how the B plus setups form with this model. So moving on to the model's foundation, the first thing you need to understand is what the higher time frame order flow is and what the higher time frame candles are telling you. So to trade effectively, understanding the order flow and aligning with the daily and weekly trends is essential for this model. So for example, if we are bullish on the weekly candle, we obviously want to see it trade higher. So how do we want to see this trade higher? Well, first of all, we expect the market to trade lower early on in the week. So we want the market to trade higher. So we're going to anticipate Monday or Tuesday or Wednesday to make low of the week for the candle to trade higher again. So as you know, one weekly candle is made up of 5 daily candles. And if we're bullish, we want to see the market dip lower first. So either Monday or Tuesday, or even Wednesday, make low of the week, and then we trade higher. And the same thing's done when we are bullish on the weekly candle. We want to see it trade higher first before it trades lower. So again, either Monday, Tuesday, or Wednesday, high of the week. And then we have the reversal for it to trade in the direction we want it to. And the key principles that you need to understand is order flow. So where does the market want to go and how it's going to go in the direction you want it to. So if you're bullish, you want to see down close candles every time price trades into them to support the market to continue trading higher. And the same thing's done when we are bearish. You want to see up close candles act as resistance, pushing the market lower. And this alignment is crucial for successful trading. So you need to know where the higher time frame candles need to go, and you need to have an understanding of what the weekly candle wants to do. Once you understand this is where my blueprint model is going to help you a lot. So moving ahead, I'm going to go over an example of higher time frame order flow. So you can see right here that price traded to the upside. And how did price trade to the upside? Well, you can see every time we traded into a down close candle, it supported the market higher until we had a reversal. Once we had this reversal, as you can see, we have this green up close candle right here. Price trades into this green up close candle and then rejects away, then trades to the downside into the drawn liquidity. So all of this movement here was bullish order flow, and down close candles were supporting the market higher. And you can see all of this movement to the downside was bearish order flow, and this was supporting the market lower. And again, going back to my framework regarding 1 weekly candle and 5 daily candles, you can see right here, this is where we opened up, traded higher, and then traded lower into the sell side liquidity. And how does this look on the daily time frame? So this is what the weekly candle looked like, where I'm pointing out with the open, high, low, and this is how it looked like on the daily time frame. So over here, this candle that I'm pointing at, this is Monday, this candle's Tuesday, this is Wednesday, Thursday, and then Friday. So you can see we opened up, pushed higher, traded into where? We traded into an up close candle, rejected away from this up close candle, and then we traded lower. So same logic, if price opens up and we are bearish, so we opened up, traded higher, traded into a level where we anticipate price to reverse. Why do we anticipate price to reverse from here? Because this is an up close candle, and if we're bearish, we want to see up close candles support the market lower. So we make high of the week on Tuesday, and then we trade into our drawn liquidity. So this is how the weekly candle logic is coming into play on the daily candles, and using order flow to confirm where the market wants to go, and everything comes together. So I'm just teaching you everything regarding the higher time frame because this is crucial. If you don't know where the higher time frame candles want to go, you're definitely not going to know where the lower time frame candles want to go. So with that being said, to add extra confluence, you can see right here we made an SMT divergence, which we are going to get into as well because this is very crucial. But over here, which I'm circling, this is the S&P 500 and this is the Nasdaq to my left. You can see ES traded into previous weekly high, Nasdaq failed to do so. So this is where we had the SMT price trading into an up close candle, rejecting away, and then trading into the objective we were looking for. So there's a lot of confluences coming together to building a bias. And again, the same framework's done right here. You can see all down close candles supporting the market higher, and you can see we made an SMT below this low. So this is where we anticipate price to not go below this low, because we've already accumulated below this low. So we will look at the down close candles once price closes above them. You can see we close above them, and once price trades back into these up close candles, it's very sensitive and it trades higher. And you can see right here, once price returned back into these down close candles, we rejected away from 50% and then traded higher, and then price retraced back into these down close candles to trade higher into the buy side liquidity. So this is understanding the order flow and pairing it up with SMT divergence. So if you don't know what an SMT divergence is, don't worry, because I'm going to go over this in this lecture. Okay, so we've gone over the most important part, which is understanding the higher time frame order flow and what the higher time frame candles are telling you. Now we're going to go over dealing ranges, because this is crucial for the model. So this is similar to what we are going to go over for our strategy, but you need to understand what a dealing range is and how they form, because it's the most important part in trading. So dealing ranges form with swing highs and swing lows, and if we do not take out one side of the range, there is no trade. So this is something that you need to understand. If we don't take out any liquidity within the range, 9 times out of 10, you're going to become the liquidity. One side of the range must be taken for us to aim for the opposing end. However, we need to emphasize the importance of using framework and context. So this is not just a pattern. So if price takes out one side of the range, you're not just looking to target the opposing end without any context. Going back to the high time frame order flow and where the market wants to go, this is your context, and you need to know where the high time frame candles are going. You can't just blindly trade this as a pattern, because this is not pattern trading. So I need to emphasize that this is not pattern trading. You need context behind why you're taking the trades. Okay, now let's go over how a dealing range forms. So you can see right here, this is our dealing range low, and this is our dealing range high. So what makes this the high of the range and what makes this the low of the range? Well, you can see this is a swing high. A swing high is a 3 candle bar, and you can see this candle to the left failed to go above the candle in the middle's high, and the candle to the right failed to go above the candle in the middle's high. So this becomes the highest high of the range, because you can see we traded lower, and this is also a swing high. And you can see right here, this is a swing low, same logic applied. No candles traded below this low, so this was the lowest low of the range. So this is where you're going to draw out your dealing range low, and you're going to draw out your dealing range high. So as you can see, we trade lower, take out the dealing range low, and then trade into the range high. So we are going to get into the context of why price traded higher, how we can anticipate price trading higher, and get into a bit more information regarding this. First, I'm going to teach you about my favorite price delivery arrays, and the main focuses are inversion from fair value gaps and order blocks. So if you made it this far into the video, I want you to listen to this very carefully, but you can see once price takes out a dealing range low or a high, you're looking for an inversion fair value gap to form. And this is not just going to be a level you're entering from, this is going to confirm price is changing market structure. So you can see price trades into a key level, so this is the range low, and then we make a bearish fair value gap. As price is trading to the downside, this bearish fair value gap should support the market lower. However, it doesn't, it closes above. So this invalidates this bearish fair value gap, and it becomes an inverse level. So as it's becoming an inverse level, you know that this is a market structure that is shifting. And this is exactly how I use inversion fair value gaps to confirm that the market is shifting structure. So as you can see right here, inversion is a confirmation. So once an inversion is formed, it confirms a change in the state of delivery and consequently a market structure shift. Once price retraces to these levels, you can use them as a buy or a sell area. However, I'm going to get into order blocks and change in the state of delivery and how they come together with inversion fair value gaps as well. So you can see right here, this is the same fractal where we trade into the key level, which is the range low. And we have 3 down close candles. So I like to use 3 down close candles for a change in the state of delivery. If you don't know what change in the state of delivery is, next slide is going to clear that up. But essentially it is an order block which shifts the state of delivery. So you can see price has been trading to the downside with my blue arrow, and then we trade into the range low. So how can we confirm price is shifting structure? Well, the first thing we look at is this fair value gap. How price behaves from this fair value gap that I'm circling. Once we closed above this, what is the next thing you look at? You look at 3 down close candles when we are bullish. So here you can see 1, 2, 3. Once price closes above this, This confirms the inversion fair value gap that we shifted structure, and then the order blocks which change the state of delivery. This confirms price wants to go higher. And you can see once we return into 50% or midpoint of these down close candles, we are very sensitive. And then going back to the order flow teaching, all down close candles will support what? They'll support the market higher when we are bullish. And you can see this is what down close candles do. So moving ahead, going over change in the state of delivery, this is going to be very important because it's going to help you confirm when the market is changing from sell side delivery to buy side delivery and vice versa. So this is going to prevent you from trying to catch falling knives or whatever. This is just going to be the confirmation you need to know when a dealing range is shifting. So my rule for change in the state of delivery is not every down close candle or up close candle is a change in the state of delivery. You must have context behind those 3 consecutive candles. And once price closes above for a change in the state of delivery, we should be trading inside of a liquidity pool. So going back to this example, what do I mean about liquidity and change in the state of delivery? Well, you can see these 3 down close candles, they traded into the key level, which was the dealing range low. Once they traded into here, this is where liquidity was. They formed inside of a liquidity pool. So once price trades above and closes above them, this confirms that these are high probability because they were formed inside of a liquidity pool. And where else were they formed? Inside of the low of our dealing range. So this will confirm once the model forms, we take out one side of the range when to target the opposing end of our range. So you're not guessing. So if price takes out one side, you're not guessing to buy or sell to target the opposing end. This gives you the context you need. So again, once price trades back into these levels, you can buy or sell as they act as an entry level. Now we're going to go over SMT and why it's so crucial. So this is one of the most crucial elements. Essentially, we confirm manipulation using an SMT. So before trading the New York session, for example, you should look for an SMT between the 3 averages. So we have the YM, so this is the Dow Jones, we have ES, S&P 500, and then we have NQ. This is NASDAQ 100 or US 100. So with your understanding of SMT, this will effortlessly validate or invalidate trading setups. So here you can see we have a range high and we have a range low. You can see we make an SMT with ES. So ES traded below this low where the NASDAQ failed to do so. So looking ahead, you can see we have a range high and we have a range low. However, price does not trade below the range low and it trades higher. Why is this? Well, this is because we made an SMT divergence with the S&P 500. So the S&P traded below this low, which was the range low, where the NASDAQ failed to do so. So this created the manipulation, and this confirmed that price does not want to go lower, and it does want to go higher into our logical area, which is the range high, and it is this swing high right here. So looking ahead, same thing's done. We have a range low and we have a range high, then we have the overall high of the range. So you can see we made an SMT at this low and then we traded higher. Again, we made an SMT at this low. This confirms the price still wants to trade higher. This time NASDAQ did trade below this low where ES failed to do so. So this created the SMT. You can see price comes back into these down close candles and then trades higher into the range high and this range high as well. But you're going to go over time frame alignment. So this is crucial. So to find high probability trades, you need 3 or more time frames to be aligned together, pointing to the same narrative. So if you're bullish, you want to see the 15-minute chart, the M5 and the M1 all pointing towards bullish scenarios. If one time frame is bullish and the other 2 are bearish, this equals a low probability trading condition. You need 3 time frames pointing to the same direction. So going back to the start of the video where I spoke about higher time frame order flow, the daily and the 4-hour, this is what you're going to use to build your context when you go into the lower time frames. So once you've built your context from the higher time frame, the daily or the 4-hour, you can move on to the M15 or the M5, and this is where you'll refine and enter from. So if you're a scalper, you'll mainly be focusing on the M15, so this is where you'll build your context. M5, this is where you'll refine, and M1 you'll enter. But I'm rarely trading on the M1 chart. I prefer the M15 or the M5. So this is the order you can use or how you can use the time frame. So the M15, this is where you're going to find your dealing range and your narrative. And on the M5, you can refine this and use it as an entry. Or if you want to go lower, after refining it on the M5, you can enter on the M1. But you need to keep in mind what the daily and the 4-hour candle is doing. So I like to use the daily and the 4-hour for context building where the market wants to go on a higher time frame level. Then I'll find my dealing range and I'll build my narrative from that, and I'll use the M5 to enter and get into the market. So now I'm going to teach you my blueprint model. We're going to go over London and New York, and the focus is time-based reversal. So this is something that you need to learn, and I'm going to teach you right now. So firstly, let's go over London, and you can see right here, this is our dealing range low, and this is our dealing range high. This is the first thing when you sit in front of the charts. This is what you need to identify. Once you identify your range, this is the swing high, this is the swing low. If you are bullish, you want to see the market do what? Trade lower and trade into the range low. So you can see right here, we trade into the range low. So first step's done, we trade into the range low. And the second step is waiting for a time-based reversal. So you can see right here on New York time at 3 a.m. if you're trading the London session, at 3 a.m. you're looking for the market to trade into liquidity, which is the dealing range low. Once you trade into this liquidity, you're looking for a reversal around this level at 3 a.m. So we're on the M15 chart right now. Let's go on to the M5. So you can see right here, we have our range low and we have our range high. And this is 3 a.m. You can see at 3 a.m. price trades lower, trades into the range low. And then what do? We reject away from this level. So how can we confirm that price wants to go higher? Well, we know at 3 a.m. this is where we're looking for a reversal, and we've traded below a dealing range low. What do we wait for? We wait for price to change the state of delivery. So you can see we have these consecutive down close candles, and we have 3 consecutive down close candles. Ignore the little green ones in the middle as they have no volume. So we're going to put all down close candles together, and once price closes above them, you can see with this candle. And if we trade back into these down close candles, this is where we're going to buy with a stop below the range low, targeting the range high, which is the buy side liquidity. So this was an example and the framework for the London session, everything we have gone over. I am going to go over New York as well. If you want more examples, I have made a checklist. So all you need to do is go into the description down below. And this is going to show you the best A+ setups and the B+ setups. And you can of course print this off and put it into a PDF or whatever you would like to do. So make sure to claim that because that's going to give you a lot more clarity regarding my model. So now let's go over a New York example. So as you can see, we have our range high and we have our range low. We are waiting for 9:30 to take out one side of this range for us to frame our reversal. So this is the 15-minute chart. We found where the liquidity rests within the market. We're going to move on to the M5 and refine everything. So you can see right here, this is 9:30. Price trades higher at 9:30. And where does it trade into? It trades into the buy side liquidity and the high of the range. Once it trades into the buy side liquidity, what is the next step we wait for? We wait for a change in the state of delivery or price to close below an inversion level. So you can see right here, we have 1, 2, 3. We have 3 up close candles. Price trades lower and closes below them. So what do we know? Once price closes below 3 consecutive up close candles, and we have a narrative behind this because we know 9:30 we're looking for a reversal and we trade into a high of the range. So once we close below this is where we are going to look to sell once price trades back into here. And you can see for confirmation when to move to break even or everything like that, you can look for an inversion level. So this is a bullish fair value gap that I'm circling. This should support the market higher. However, it doesn't. So you can see price closes below this bullish fair value gap. So this is where we know that price does want to trade lower and trade into the sell side liquidity. And it's not just a random level of sell side liquidity. That is our dealing range low. And you can see once price takes out the range low, it has a little reaction away. And this is the exact framework you need for New York. However, I do have a lot more examples within my PDF checklist, so make sure you claim that because it's going to give you a lot more clarity. But with that being said, this is my most profitable model and I'm very excited to see how you guys get along. And if you do have any questions, make sure to join my free Discord because that's where I can answer them for you. But with all that being said, I hope you found this video insightful. Remember, I'm rooting for you and I hope you find success in this business. As always, enjoy the rest of your day.